Hello everyone, welcome back to Chill Deal Trades, where I analyze stocks so you know what's going on. Today we're actually going to cover one of my favorite companies, ChargePoint. It's CHPT, and if you haven't heard about them yet, you need to do some research on your own. But today in the video we're going to cover both kind of what the company is, I would say the pros and cons from my perspective, as well as looking into the chart to figure out where the price could be headed. And maybe where some buy opportunities are. If you're here and you haven't hit the sub button yet, please hit that. We're on our way to 500 subs, and once we get to 500 subs, I'll be doing a Friday live stream for all y'all. So once we get there, you guys can jump on with me and we'll do some live charting and analyze some stocks together. But let's get into things. So the first thing I want to bring up before I get into the stock is why I'm so bullish on EV and kind of the metrics behind of potential growth for the industry. So the first thing I want to say is by 2025, 2.5 million EV charging spots, 50 times increase in electric vehicle charging infrastructure, 50 times increase, and that's 4 years. In 4 years, we're expecting a 50 times increase in charging infrastructure. That is massive, and I think that's because we're seeing a mass adoption across all types of I guess car industries. You have the consumer, more electric car companies, so more electric cars are being bought. You have the business side of things, so like FedEx, UPS, they're starting to get into electric. You have the USPS, they're getting into electric. So you have all these industries kind of starting to collapse at once, where we're going to see exponential growth, and part of that is in charging. If I didn't say it already, ChargePoint is a charging station company, but we'll get to that some more in a second. And just to build off that, when we look at the major car companies, they're in the next, I would say 10, 15 years, they're all expecting to get at least 50%, not to 100% of their vehicles to electric. That's going to be massive, and when we see such a large growth, we're going to need more infrastructure for those cars to be charged. Just more facts to the same point, this kind of turquoise area, that's the expected growth in battery charged vehicles, or vehicles with batteries in them. And the last thing is ChargePoint is expanding internationally, but you do see the US, which is where their majority of their charging ports are, is in the top 5 countries. And so there's a big infrastructure being built out. If you guys don't know, Joe Biden is the president. He is probably the biggest green bug president that we've had so far. And so he's making huge investments into the EV space, and ChargePoint is only going to benefit from that. So I think that's all we have there for the industry. The first thing I want to point out is just ChargePoint as a company. So since we're already on this tab, ChargePoint is 73% of the charging industry, and the next closest competitor is 7 times smaller. So ChargePoint is early mover. They've been around the longest. They're the most well known. They have the infrastructure built out already. There are some cons to that, as whenever you're building a business in an industry that's exploding and technology is getting cheaper and cheaper and advancing, you can typically have a lot of turnover, because if we go a couple years ago, we had like 120 volt chargers. Now we have 240, and now we have 480. And so when you see such growth, those companies are going to need a lot of capital to continue their growth. And so it's a pro and a con to be a first mover, because a lot of ChargePoint's stations out there are slower compared to the newer charging stations that are coming out in terms of how fast they charge your car. But let's go into the company a little bit, just to give you a little bit of background. So what I really like about ChargePoint is they have 3 lines of business. They sell hardware, software, and services. And so they're going after commercial, fleet, and residential. So they're going after everybody. They're not just residential. They're just not at home. They're not just that when you go to the grocery store and there's a charger. It's also for businesses, and so they're going after everybody. And what I really like, let me move down here a little bit, is the winning formula. So if you look here, hardware, software, and service, I would say companies that are just the hardware, it's going to be really expensive, because you're going to have so much turnover in your product, and you're continually have to innovate. You have to tear old ones down, put new ones up. But when you can have a SaaS aspect to your company, and this is a great example of why Tesla succeeded. Tesla was not just a car company; they were a SaaS company. They had software in their cars that they constantly updated, which would make their cars better and better over time. And that's the same thing with ChargePoint. They're not just a hardware company; they're a SaaS company, and that's going to be, I would say, the long-term money maker and recurring revenue for the company in the long term. So there's a couple things there. I also want to go to the growth they're expecting, and so I would say these numbers are extremely bullish and most likely not achievable. But the main thing to call it here is 60% growth on average over the next 5 years. If this company can see somewhere between 40 and 70% growth, then we're going to continue. Then we're going to see this stock as we're going to see this company as a stock that we want to continuously buy over the years. Now I want to get into some news. So the main thing I want to call out is we're just seeing so many partnerships for ChargePoint. If we kind of go through here, Mercedes-Benz, they're working with, where's it at? They're working with companies, lease plan companies to build out infrastructure for them. There's another one, Volvo. They're expanding their collaboration with Volvo. Polestar. There's so many companies. There's so many car companies that are partnership, as well as obviously they're building out as cars go more digital. They're enhancing so that you can find where their charge station is. When you think of how companies are going to be successful, you need to be able to find the company that's going to succeed is the one where people can find their charge stations as quick as possible. It's not just how many you have, but how easy it is to find them. And so partnering with companies where they can build out applications in maybe Volvo's car right away, or partner with Android Auto so that their charge stations show up. These are all really big positives. The next thing I want to take a look at is institutional buying. So you know me, on my videos, institutional buying is such a big deal. And so what we see here in Q2 is almost $2 billion of institutional buying, which is major. When I look at companies that I want to invest in, I want to see billions of dollars poured into them, especially as high growth, because there's so much risk involved. You know, what if the company doesn't grow at 60%? How does that transfer to the value of the company? And so when I see companies spending billions of dollars to acquire shares, that's extremely bullish. And when we go right here, another thing with institutions buying, over the last 4 months, you've seen 3 people buy in substantially to the company. Just a few days ago, you had this company invest they bought 37 million shares and 11% of the business. So you can just see here, there's so much buying going on. People want to acquire shares. People want to own the business. Through institutions want to own the business. So this is extremely bullish for the stock in the long term. Last thing I want to go to, a couple of last things before we get to the charts, is they did just have a share offering. And so this isn't the first time we've seen this. They also had a share offering back in March, a pretty big one, up to 246 million. And this is something that I believe we're going to continue to see. I mentioned in my video yesterday when I covered Virgin Galactic, go watch that, is these companies that are expecting these large growths, 60% year over year, Virgin Galactic was like 100% year over year. They need millions and billions of dollars to get to the growth that they need. And the only way to do that is because they're not making money as a company. They have to sell shares to get that money. And when you sell shares, it dilutes your shareholders. And that just means that you need to have much more people buying in to keep that stock price going up. And so this is one of the big things that we need to look out for, is how many more of these bigger offerings are they going to do? 12 million shares, it's a lot. It's not a crazy amount, but this is something we definitely want to keep an eye on. Lastly, before the charts, just looking at revenue. So we did see quite a bit of slump, but that was mostly versus COVID. And so this is another potential risk, is the COVID-D variant. I've mentioned it in a few videos, is how are we going to see the US and other countries, because this is an international company, how are we going to see them react to this? Are we going to start seeing some shutting down by states? Or are we going to see certain countries shut down? And this is why their revenue struggled so much through 20 and 21, is because people weren't driving. If people aren't driving, then they don't need to charge their cars. And so when they don't need to charge their cars, this company's not making money. So I would say the share offerings and the potential risk of more COVID shutdowns, I would say, are the two biggest I would say the two biggest things that you need to keep an eye on, as it could have a negative impact on the stock. As we bring up, we obviously know this company is not profitable, but they are expecting big growth. So 29%. Obviously, we basically see no growth in 21, but that's mostly due to COVID. But we are going to start seeing accelerated growth moving forward. Again, this company is not profitable. They're EBITDA profitable. They're spending a ton of money to continue to grow, which they're going to have to get. They're going to have to put more shares on the market, which dilute us, the shareholders. And so that's just something you want to keep an eye on, is how do we see this revenue trend for reals? Not just the estimates that they think they can hit, here, 300 million by 2022. What are they actually going to hit? That says 200 million. So what numbers are they actually going to hit? And if we see a big difference between what the company said they could hit when they first listed as a SPAC compared to what they actually hit, if those numbers are much lower, then the price is definitely going to have to come down to the stock. The last thing I want to cover for the last couple minutes is just the chart. So I personally sold this company back last month because I just felt that a lot of these names were being moved higher. They were moving way too fast, and that's why I sold out of a lot of my high-risk growth stocks. And if you've listened to me over the last couple weeks, you could have saved so much money by not buying in or selling at some peaks in stocks. I'm telling you, I'm not making stuff up in these videos. I've done this for many years. I'm trying to help you guys out. But a couple things we want to look at. The first thing is MACD. So we did see MACD momentum turn negative back at this peak, and so we're going to want to see if this blue line continues below the orange line and starts going negative. If we break below 0 on the MACD and we have that same lines blue below the orange, that's going to be a lot of negative momentum to the downside in the long term. The next thing I want to look at is we did see RSI go back below 50, and as I tell you everyone, RSI doesn't tell you when something's oversold and overbought. It also tells you momentum. So as long as this stays under 50, we're going to have negative momentum. We just only peaked out here and we went back below. So that's, again, MACD and RSI are both showing negative momentum for the stock. I'm going to X out of these so that I can bring up more moving averages. And if you sub, that means I can get the pro version of this and I don't have to do this janky stuff for you guys anymore. So please sub. Because the last thing I want to get at is just kind of where we're seeing maybe some price resistance and looking at the moving averages. And so as we can kind of zoom in, something really important, we have the 100-day, 200-day, and 50-day all in the same place. And so, the stock tried to hold that range, but as it went higher, it actually gapped down lower, and that was mostly due to the share offering. But if we can't get above these moving averages, that's extremely bearish, because if we continue to move lower, we're going to see the moving averages align in a way that's showing us negative momentum. And so I think we can probably get a little bit of a relief rally here in the next couple days, but in my opinion, I think we have more downturn in the short term. And so kind of, I would say my buying range is if we can't hold $24 in the next coming weeks, then I'm going to be buying in this $23 to $19 range, kind of this bottoming pattern. There's so much support here because there's so many people that bought in. All those institutions bought in at this price. You just see this back and forth means a lot of buying. And so if we do break below this support right here over the next couple weeks, which is $25 to $24, we are definitely going back to this consolidation zone, and that's where I'll start to be biting on shares. As we see in the past, this whole was just a gigantic move higher, and so there's going to be parts of that are not going to have much resistance. We don't have much resistance right here, and that's why we've got a big red candle today. We have a lot of resistance in this little gap, but if we break below 24, then we're definitely heading back into this consolidation zone, and that's what I'm going to have to start considering if I want to buy shares or not. And I would say you should want to consider the same thing, but I'm not a financial advisor. But thanks for watching that video, guys. I really appreciate it. As I said before, goal of 500 subs, and when we do, I will be live streaming on Friday nights. But thanks for tuning in again. If you're here for the whatever number video or the first time, I make videos daily, so I'll see you again tomorrow.